This is News.Markets. When Chinese stocks nosedived over the summer, shockwaves were felt throughout global equity markets. Now, totting up the losses from some of Britain's biggest companies, from miners to luxury fashion brands, the slowdown in China has wiped off around £79 billion from their combined market cap. The FTSE 100 has only rebounded 50% of its value since hitting lows in August, while its overseas counterparts like Germany's DAX and the S&P 500 in the US have regained much of their value. So what is the impact of the emerging markets slowdown on UK blue chips, and how long will it last? Well, FX Pro's chief economist Simon Smith joins me now. Look, disappointing results from Standard Chartered. Demand slipping for metals, hitting Glencore, sales growth targets being missed by Burberry. Is it all about China?
It's certainly a feature. Looking back now at China and what happened in August, I look back with a sense of a bit of wonderment about why we got so worried about it. The Chinese stock market is not like any other stock market. It's around 20% of GDP. If you look in other economies, especially the UK, US, it's much more than 100% of GDP. There's no correlation between the Chinese stock market and their own economy. There's no correlation normally between the Chinese stock market and pretty much any other stock market. So we suddenly got worried. Why was that? I think China was already slowing before August. I think the stock market sort of reversal we saw, I think, was a manifestation of that sort of third wiped off shares over the space of a very short space of time. And I think that was, there's something to worry about here. But the slowdown already happening, the easing from the PBOC had already been happening over the past year. I think it's just when the concern is a lot more in the credit, the build-up of credit within China over the last sort of 3 to 5 years, which was the thing that stopped China from slowing when the rest of the world was slowing. I think we just saw the manifestation of that. Actually, something's going on in China. People have talked about it and not really seen it in the numbers.
They're not seeing it in the numbers. How do you explain the FTSE not recovering anywhere near as much as, say, the DAX, as, say, the S&P 500?
There's always the sort of much more international focus of the FTSE in terms of the shift towards energy as well. The S&P just had a miraculous and very sharp recovery in October. It's one of the strongest performers of nearly all the global indices, even the emerging market ones. I think the S&P was the outlier. DAX, yes. I think there are other stories going on there in terms of some better numbers coming out through the Eurozone. The FTSE by nature and by construct and nature of the businesses within their much more international construct, in the sort of mining sector, energy, it worries more about China for those reasons, because a slowdown there in the global emerging market space is going to have bigger implications. They're bigger consumers of resources and energy as well. So I think the scar is longer and more deep in the FTSE, and I think that's probably the right thing.
What about the impact on other emerging markets?
Of course, they have aligned themselves to varying degrees to China. As China has sort of moved along the value chain, they've benefited as people have outsourced production to those markets as well. So we're seeing that, especially with the Fed rate hike likely to come in the next few months. I don't see December, but the early part of next year. That removes dollars. Those are dependent on foreign capital, especially short-term funding. Look at Brazil, look at South Africa, look at Turkey just after their elections. They're still very vulnerable to the wider environment.
You talk about Fed moves, not for the next few months. Now, I know last December you said you didn't think that any moves would happen in 2015. Do you still stand by that?
It's very late in the day, so I go down in flames or glory. So I think I do really. Just on the basis, I think they do really want to be sure that the worst thing they can do, you've seen it from other central banks, seen it from the ECB, you've seen it from the Fed in the 30s, you've seen it from Japan in the last few years and previous 10 years. There's nothing worse than actually tightening rates and then 6 to 9 months later having to reverse that move, especially when rates are already very low, the policy options are limited. They'd rather wait that bit longer to sort of, we're sure of this, as we can be in central banking terms, and then be sure as they can that is the start of a tightening cycle and not just one move that then gets reversed.
So no move in December?
No.
When do you think the next move will be?
I think we will see it probably in the first quarter, but probably March. I don't see it necessarily happening in the early part.
Well, I'll remind you of that next time you
Please
come in. Well, Simon Smith from FX Pro, thanks ever so much.